In 2010, one pizza cost 10,000 Bitcoin. In 2026, one decision could change your next 10 years. Banks that mocked crypto are quietly integrating it. Governments that tried to crush it are drafting rules to live with it. And after the 2024 halving cut new issuance to 3.125 BTC per block, a new game began. Smaller supply, bigger buyers. Here's the part most people miss. Bitcoin isn't just number go up. It's policy you can't print, rails that don't sleep, and a network that monetizes time itself. In every prior cycle, the crowd woke up after the move. 2013, 2017, 21. Every time, fear turned to FOMO, too late. "2026 could be different, not because of hype, but because of plumbing." Spot ETFs unlocked retirement money. Public companies learned treasury playbooks. Lightning and other layers made small payments instant. While headlines argue, on-chain data shows coins moving from exchanges to cold storage, quiet hands setting the stage. Today I'll show you what could realistically happen by 2026, the 3 catalysts almost no one is modeling correctly, and a simple risk plan you can copy-paste. Watch to the end. Whether Bitcoin becomes your hedge, your growth bet, or your first step to financial sovereignty, the next moves are decided before the crowd sees them. Breathe, focus. This is your early signal. Where we are now, and why 2026 matters. Post-halving dynamics. In April 2024, block rewards dropped from 6.25 to 3.125 BTC. That's a structural 50% cut to new supply forever. Historically, major cycle tops followed halving events by patterns in 12 to 18 months as shrinking supply met rising demand. 2026 sits squarely in that window. Demand shift. Spot Bitcoin ETFs, approved in the US in 2024, pulled in billions in retirement and advisory capital. That is patient rules-based demand, very different from retail FOMO. Macro tailwind. High debt plus sticky inflation makes hard, provably scarce assets attractive. If rate cuts or liquidity easing arrive in 2025, risk appetite expands. Bitcoin historically responds with reflexivity, price via attention, demand. On-chain posture, exchange balances trend down. Long-term holders dominate. Translation: fewer cheap coins available when momentum returns. What changes? ETFs turned Bitcoin from a tech curiosity into a ticker advisors can buy. Even a tiny model allocation, e.g. 1 to 3% of AUM, is massive when scaled across pensions, REAs, and corporate treasuries. Real examples. MicroStrategy pioneered a treasury strategy, debt plus cash flows, BTC. Love it or hate it, it proved a board-level playbook exists. Multiple public companies already hold BTC on balance sheets, varies by country jurisdiction. Why it matters. Programmatic buys don't chase headlines. They rebalance on schedules. That creates persistent bid pressure. 2. Scarcity going mainstream, halving plus self-custody trend. Mechanism. New supply halves. Meanwhile, more users move coins to cold storage, tightening float. Signal. When price cools and exchange balances still fall, that's smart accumulation. When momentum returns, supply is thin. Moves become outsized. 3. Utility rails. Lightning and payment integrations. What's real? Lightning and other layers make micropayments and instant settlement possible. Cross-border transfers without banking hours or chargebacks. Why it's underpriced? Most models value BTC as digital gold only. Payment optionality is a free call option on top of the store of value case. Bridgeline. Catalysts are nice stories, until you see how they've already played out in the real world. A decade ago, corporate BTC was unthinkable. Then a listed company accumulated billions in BTC, issued notes against it, and survived multiple drawdowns. Outcome, boards now have a case study, and consultants who can execute it. Expect copycats, especially in tech and energy where cash piles seek asymmetric upside. Nation-state experiment. One Latin American country made BTC legal tender and issued Bitcoin-linked bonds. Whether you agree with the policy or not, it proved political will exists. In regions with weak banking and remittance fees 5%, BTC rails plus stablecoins plus Lightning remove friction, the fiat system can't. Emerging market adoption. In cash-strapped economies, Africa, South Asia, parts of LATAM, peer-to-peer volumes surged when banking access was limited. For many, BTC isn't an investment. It's the only open rail to move value, hedge local currency, or accept online income. Takeaway: Bitcoin's demand isn't one demographic. CFOs, coders, and corner shops, each for different reasons. So what could 2026 actually look like? Let's break it into scenarios, not predictions, but probabilities. Base case, most realistic. Bitcoin continues its 4-year rhythm. With halving supply shock plus ETF inflows, price could challenge 120K, 180K. This assumes steady adoption, no black swan, and macro tailwinds. Bull case, if institutions scale faster. If corporate treasuries plus pensions move from 0.5% exposure to 2 and 3%, demand dwarfs current supply. In this case, we could see 250K, 400K prints by 2026, not guaranteed but mathematically feasible. Bear case, if regulation or liquidity dries. Severe recession plus harsh regulation could stall flows. BTC might hover 50K, 70K. Even then, that's above pre-ETF levels, proof of structural resilience. Message: Bitcoin doesn't need moon targets to matter. Even the conservative case outpaces most traditional asset. 1. Position sizing. Never risk money you can't lose. Think percent of portfolio, not all in. 2. Time horizon. Treat Bitcoin as a multi-year asset. Cycles take time, weeks of boredom, days of panic, hours of euphoria. 3. Custody. If you buy, learn storage. Exchanges are convenient, self-custody is sovereignty. 4. Narratives versus noise. Ignore daily headlines. Focus on halvings, adoption, regulation, and on-chain signals. 5. Optionality. Layer small exposure to adjacent plays, layer 2s, Lightning infra. But keep BTC core. Mindset shift. You're not trying to beat traders. You're front-running inevitability. Every cycle, the story repeats. In 2013, they called it a fad. In 2017, they laughed at the crash. In 2021, they said institutions would never come. And in 2026, the headlines will scream what the early ones already knew. Bitcoin changes the rules. But here's the truth. Most people will wait until it's obvious. By then, the move is gone. The difference between watching history and being part of it is preparation. If this breakdown gave you clarity, hit that like button, subscribe, and turn on notifications. Because in my next video, I'll go deeper into the hidden opportunities surrounding Bitcoin. Projects building on top of this revolution that could multiply even faster.